Hey guys, it's May from Markets with May. In this episode, we're going to be talking about 3 types of cryptocurrency. This is episode 5 of my series on why is the SEC suing Binance and Coinbase. But I wanted it to be a standalone episode because I wanted to do this video for some time. Now, while those 2 lawsuits really are about the exchange function and failure to register, as well as staking as a service violating the Howey rule, also the case that these 11 coins were named in the lawsuit as being security. And in most cases, none of these coins are registered with the SEC. Now, for a lot of folks, you'll hear the word currency and it's confusing as to why the SEC should be involved. Isn't it the CFTC that regulates FX transactions, foreign currency transactions? It is the case that currently Bitcoin and Ethereum are both recognized as commodities. But it is absolutely also the case that many coins are legitimately acting like a security. I would mention that the crypto community is quite divided on this issue. Some people believe all cryptocurrencies should be regulated by the CFTC or not at all. And others think it's high time that regulation stepped in. And we're going to get into all that in this episode. I've divided this episode into 3 parts. First, we're going to describe the difference between a coin and a token. Second, I'm going to go into the 3 different types of cryptocurrency that matter for regulation. Third, I'll wrap it up with some additional considerations for folks researching this issue. Before we get into that, the disclosures, past performance is not indicative of future returns. I am not telling you to buy or sell anything. And then full disclosure on my investments, I am long BITO, which is a Bitcoin ETF. I own some Satoshis, and I do have XRP and Ethereum. I am presently short Coinbase, but on any given day that'll change, long or short. Now let's get into 3 different types of cryptocurrency. I wanted to get this jargon word out of the way because there are some crypto folks that hear it like nails on a chalkboard. Personally, I think the difference between a coin and a token matters a lot more if you're a computer science nerd and a lot less if you are a finance person. But for those folks, a coin has its own native blockchain and a token is built on top of a coin that has its own native blockchain. What do I mean by that? Bitcoin is a coin. Stuff is built on top of Bitcoin. Ethereum is a coin. Stuff is built using the Ethereum coin. Cardano ADA is a coin. Solana is a token. Solana is built using Ethereum's coin. Now this matters a ton for the computer science nerds, the implementers, the programmers. For the finance folks and folks that are watching what's going on in regulation, it matters to the extent that it makes a difference as to whether or not that coin is therefore more likely to be a currency or more likely to be a security. Now let's be really precise on what I mean by that. You still have to pass the Howey test and you also have to pass the 2019 framework that the SEC published. Now currently, Bitcoin and Ethereum have been named by the CFTC as satisfying the requirements for being a commodity. Now I do want to take a minute and just describe what the CFTC regulates versus what the SEC regulates. Now the SEC regulates companies. To simplify for this discussion, the SEC is interested in protecting investors from types of fraud that could happen as relates to a company seeking capital. That includes people that are selling shares of a company or some investment product related to a company. That also includes market mechanistic manipulations that might, having nothing to do with the company or the investor, be creating an unfair environment for investors. If you're just an asset that increases or decreases in value and other people are coming to trade you, that's the CFTC, because the way that the world looks at that is as if that is a financial derivative instrument. So if you're going to buy wheat directly from the farmer, that's not a derivative contract because you're giving the farmer directly some sort of payment for wheat. However, if you go on an exchange and you purchase wheat for some time in the future, that contract is derivative upon the wheat being delivered to the exchange. The wheat itself has no ability to speak for itself. Now, for simplicity, it's the market that sets the price of the wheat. The CFTC is going to govern and make sure that the wheat that comes in is to a very particular specification and that delivery happens when it's supposed to happen. The commodities markets go way back, and when they're singing it's a commodity, there's specific definitions for what that is, all the way down to if you're bringing oil to the exchange, it's usually a very specific type of oil, light, sweet, crude, and it's got to pass a very specific test. And if it fails to do so, that's a problem. The way to really think about this is to compare the crypto markets to something like the oil markets. And this is where people talk about the CFTC regulating through enforcement versus the SEC regulating through regulation, notification, that sort of thing. Because oil doesn't go to the CFTC and say, hey, I'm regulated. Oil companies might lobby on behalf, or an oil group of interested parties might lobby on the behalf of how oil should be regulated. But oil is not a physical human being or anything like that. And then again, you have oil producers. Those are SEC regulated entities. And oftentimes the commodity can trade very differently from the company. And if you want to invest in oil, you want to invest in wheat, there's no one to give you a disclosure. The broker-dealer might need to give you some disclosures, but oil, wheat, it's not a person, it's not an entity. But if you want to invest in an oil company, you want to invest in Exxon, you want to invest in a farming company that makes wheat, you want to invest in Archer Daniel Midland, those companies are going to have to disclose and tell you all about what's going on and how they're making their money. Now, where it gets dicey is that these cryptocurrencies are technically made for man and don't exist in and of themselves. As such, regulation is a little bit stretched in places. There are some areas that are definitely not gray. And in all cases, for companies that are on the line, they can absolutely write into the SEC for review and get a no action letter. And that really brings us to the definition of each of these three different types of coins. The first one we're going to go through is a utility coin or token. Now, utility token is not a legal name. It is an industry name. And essentially, utility tokens are going to be tokens that do not pass the Howey test and also do not violate any of the frameworks that were given by the SEC. Utility tokens truly should be coins or tokens that only make sense within the system itself. In other words, it should be similar to buying tokens at an arcade. In America, we have a very famous one called Chuck E. Cheese. So Chuck E. Cheese has a lot of locations in the US, and you buy tokens in order to play the different video games. But once you leave Chuck E. Cheese, no one's buying your Chuck E. Cheese tokens for more than you paid for them. And also, generally speaking, no one's taking your Chuck E. Cheese tokens so that you can get milk or bread or something from the grocery store. And additionally, currently there's no way for you to put your Chuck E. Cheese tokens with the bank and then in some other country pull out your Chuck E. Cheese tokens in the form of someone's fiat currency. If you want your money back, you're going to have to go to Chuck E. Cheese and go to the booth and have them switch it out. Quite a lot of cryptocurrencies have marketed themselves as a utility token, even though in other spots of their white paper, they very clearly are not a utility token. But there are two cryptocurrencies that got a no action letter from the SEC. These two do actually have a token that looks more or less like our Chuck E. Cheese or arcade token. Now, the two companies that have received a no action letter are Pocketful of Quarters and also Turnkey Jets. Now, the key component of Pocketful of Quarters that allows it to continue to have the no action letter is the fact that the quarter sales, the sales of the token themselves, are not able to be traded outside of Pocketful of Quarters, and also the use of proceeds is not to build out the infrastructure of the organization. And another facet of what allowed Pocketful of Quarters to get the no action letter is the entire platform was already built out in advance of a token. Now, even with the no action letter, the SEC reserves the right to revoke the no action letter if conditions change or the business model changes. Now, commodity token status is probably the holy grail for any cryptocurrency because that would mean that you're regulated the same as any other currency. Currently, Bitcoin and Ethereum have been recognized by the CFTC as commodity currencies. However, the SEC is taking a closer look at Ethereum. Now, it gets really dicey with Bitcoin and Ethereum, but even more so with Ethereum. Bitcoin was really created as a store of value, and while it does have a foundation that definitely promotes the use of Bitcoin, the evolution of Bitcoin is a little bit different from the evolution of Ethereum. There's a lot of documentation on this on people that fall on both sides. I remain neutral. Obviously, I told you I still own Ethereum. But the issue that's arisen for Ethereum has to do with its shift to proof of stake. Now, proof of stake is a very specific type of consensus mechanism that diverges from proof of work. Now, without getting too technical, the issue is that proof of stake has this concept of a validator within it. And essentially, you're staking coins, meaning the person with the most coins technically has a bigger ability to benefit than other folks. Now, validation in itself wouldn't necessarily cause the SEC too much of a problem. Tons of articles on that. I think where the SEC starts to have a little bit of a problem, or at least starts to investigate, is when the sale of the tokens then goes into a foundation that then invests in a company that then builds out the use case for Ethereum in a particular way that then collects more money and puts it back into the system. They are mostly checking to make sure that no parts of these various structures violate the Howey rule and therefore require registration with the SEC. And again, I've said it in every single video, you could do whatever you want offshore. It's when you do it onshore that it becomes an issue. And because Ethereum has so many nodes that are located in the US, the SEC is saying, hey, you're doing that onshore. You're not doing that offshore. Now let's talk about a security token. And the security token issue has kind of a twofold issue for the SEC. The first part has to do with the disclosures part of what it is people are actually buying. And the second part has to do with the taxation part. Right now, with a lot of the stuff that's in the news, people are focused on the registration disclosure part, but the taxation part is just as relevant for why there's incentive for a company to not be considered a security token. Now, in episode 1, I spoke about the Howey rule, which is the main determinant. I spoke about it in the context of proof of stake. In this episode, we're going to talk about a more direct way of looking at individual crypto coins that is relevant, and that is this memo that was put out by the SEC in 2019. This document further clarifies the Howey rule and lays out 3 things that if a company does these 3 things, then yeah, it's a security. The first is, did they take in money as investment? Second, common enterprise. Is everybody's assets all pooled together? Third, when people gave you the money, did they have an expectation that the profit of it would be derived by the activity and efforts of others? And now specifically as relates to the efforts of others, they talk about the reliance of the efforts of others, not random maintenance that happens every now and then. They're talking about the idea that the effort of others is going to be to grow and market that particular instrument actively. And that's where a lot of the coins really start to fail. Now, they also make it really clear that if the coin would not exist without this capital, and that the capital is 100% being used to develop out the coin, build it, pay for programmers, that's also a big flat no. And like I said, this was put out in 2019. And so there's been a lot of commentary on it, and there have been subsequently companies that have come forth to just ask and clarify whether or not their specific coin or token requires registration. Now, as relates to the Coinbase lawsuit, remember the SEC is still demonstrating that proof of staking itself violates the Howey rule. If any of these fail the Howey rule and also fail this framework, then the SEC has more than one incident for why Coinbase needed to register and did not. Now, that brings me to why I would have done this episode regardless of whether or not the lawsuits had happened for Binance and Coinbase. When I was doing research on initial coin offerings or creating a coin for a client, I realized very quickly that there were certain tax efficiencies if this structure was allowed to exist without registering with the SEC. Now, I'm going to try to keep it simple. You will need more than one corporate structure to achieve this tax advantage to the extent that it's allowed by the SEC and by the regulators. As relates to taxation, to the extent that your product is the coin and your business is designed to make the coin itself interesting to use, own, or otherwise, then your product being the coin is not being booked as revenue. It's essentially the equivalent of booking it as paid in capital. But again, because the coin just sits on the blockchain and isn't an actual structure or company, there's no real filing of it. The money just magically appears. This fiat currency just magically appears. And then from that, it's then funneled into a second corporation, again, paid in capital. You then have no real revenue, and you essentially are just a marketing arm for whatever activities that you want to do. Now, usually that second organization is structured as a foundation, so when it takes in the donation, the foundation goes about its business like any foundation, except that it also then invests in other organizations that are then initiating another coin, taking in fiat currency, and then so on and so forth. And this trail of selling coins just has no taxation associated with it, and that is a little bit of a special thing. Now, the last thing I'd mention is that if you're going to do more work on this, just realize that you can raise capital offshore. I keep saying that in every single video, but I want to make sure it's clear. Pocketful of Quarters has filed for a Reg S exemption for raising money offshore. Well, that ends our series on why is the SEC suing Binance and Coinbase. If you still have questions after all these videos, please do put them in the comments below. It helps me figure out what types of videos my audience will have interest in. Like, share, comment, subscribe to my channel. Now, if you missed the previous episode of this series, they can be found here. And until next time, good luck in these markets.